So, Mike, what do you think the USDA report brought to the market?
Boy, it brought a lot, Luis. It had something for everybody. Starting with the wheat market, I think that the soft red wheat acreage base here jumping 12% year over year really indicates that wheat bought some acres east of the Mississippi River. And I think you're going to see a lot more double cropped soybeans in south of I-70, where you can get a better crop insurance policy. So I think you have cut some corn acres out of the mix as a result of the winter wheat plantings. You've confirmed, in my mind, a strong acreage base for soybeans. And I think that put back into place a real battle for acres heading into the springtime, especially if you tie together the USDA report with the fact that the U.S. National Weather Service, CPC, came out with a new ENSO update this month and suggested we were going to be looking at La Nina all the way through into March. And that really suggests that we're going to remain dry in the hard red wheat belt and relatively dry in the middle part of the country, which would include Iowa and portions of Illinois based upon the recent drought monitor. So I think that kicked us off with a lot of uncertainty and refocused the trade back on buying corn acres back against the soybeans. In the soybean complex, and this is probably a real-time issue because of the weather in South America right now, I was really struck that USDA came in and kept the Brazilian soybean production at 133 million tons. That was unchanged. I believe it was CONAB that came out a day later, and it was at 133.7. I'm sitting here saying to myself, where's the drought in Brazil if these numbers are this big? Because, I mean, we were doing less than 120 million tons for Brazil 2 years ago. And I think last year was something like 124, 126. So I don't know where the drought is in Brazil if these numbers are correct. So I think that opens the downside up in the soybeans again, even though we've got such a tight stocks number here in the United States.
Mostly, I guess, compared to other countries.
Yeah, that makes sense to me too, that the logistics would be favorable for us, and especially with the bilateral trade between the Brazilians and the United States picking up recently. I also can say that our wheat belt here in the United States is kind of a tale of two cities. It seems as though the weather pattern is setting up so that it's going to be a better crop potential for the soft red wheat because snows and rain and not as damaging winds are coming into the soft red wheat belt now here in the middle of January, while the ground is still not too frozen. However, out in our area, the hard red wheat belt west of me on the Missouri River, it's getting pretty significant because there are areas that were missed for the last rains and snow about 2 or 3 weeks ago. And we've had consistently 35, 45 mile an hour winds for the last 36 hours. And one wheat client was suggesting to me that this might be actually taking wheat out of the ground because there's no snow cover out there and it's still very dry in his area. So I think that hard red wheat should start to gain on the soft red wheat as we go through winter time. I'd be disappointed if it didn't. I also think that if the dollar is made a low, that the soft red wheat would be the one that would be hurt most by that because most of the managed money longs play the soft red wheat. So if you're an inflationary bull and you see the dollar starting to make a low, I think the soft red wheat would see long liquidation, and that would help the hard red wheat, soft red wheat spread even further. So that's going to be a big spread I watch here the next 60 days.
Another issue that has impacted the market is the waivers that refineries of biofuels will receive. So, what do you think of that will impact on corn?
Well, I think it will keep a lot of potential new bulls or new longs out of the market, quite frankly. I mean, we had a fairly clear picture of the corn market up until this past week with these EPA announcements or news wires, rumors, whatever you want to call it. I don't know what is actually going to happen and what's not because it's the outgoing Trump administration that is putting out a lot, it sounds like, in terms of switching policy and helping refiners and helping the oil industry more than he is the U.S. biofuel industry. I don't know if that's the fact or not, but that's what the market has got to deal with. And I can tell you that after the USDA report, a lot of traders were, I mean, we went limit up after the USDA report in corn. That tells you a lot. The USDA numbers were a lot lower than the trade was thinking. And the trade was understanding finally that we needed to ration corn as much as we did beans. And so this EPA thing really puts a question mark in the analysis, because it could really damage the spreads if we start to see ethanol producers and ethanol crushers begin to pull back on their bids and their production levels as we get into the springtime. And what convolutes and confuses things even more, Luis, is that a lot of cattle feeders and poultry feeders and hog feeders have gotten very accustomed to using DDGs, and they work really well in their feed mixes. Well, if we have less DDGs, you're going to have to go back to soy meal and corn. So does that give you a little bit more of a bump in demand for a time period in the cash market? And do we see a situation where the cash market kind of divorces itself from the futures market? Because I don't think the funds will like the idea that we're going to lose ethanol demand, especially if energy policy shifts to more solar and electric and wind at the expense of fossil fuel energy policy, i.e., where the subsidies go. And so I think this really opens a door and opens a can of worms up here for a lot more volatility in the corn market, especially the front end corn, where you don't have to buy as many acres.
Yes, and how are you seeing the macroeconomic side impacting both corn and wheat, which are the mostly domestic market impacted commodities, farm commodities, I guess? How do you think this high unemployment generated in December is affecting?
I think the market, generally speaking, in a term we like to use in the United States, is whistling past the graveyard. They're ignoring the fundamentals of the COVID and the unemployment numbers right now, and they're thinking that the vaccination program, while we're going through a short-term dip in employment and dip in economic fundamentals, we will recover quickly in the not too distant future. And I think that's a real question mark in my mind, whether we will or not, especially given the slow rollout here. I don't hold me to these numbers, but I think as of this week, at the end of this week, the CDC was suggesting around 30 million or 31 million doses of vaccination had gotten out in the United States. I believe only 12 or 13. I can't remember the exact number, but it was like a third, if I remember right, of the actual doses available had been administered at this point. And here we are in the middle of January already. So I am a little bit, I remain very nervous about the macroeconomic situation. And I was back on the hedging side of the live cattle this week when we pushed through the 119 level for the fat cattle. Some of my clients I'd taken a little profit for, and when we had pulled back, and we got back into those hedges at the end of this week.
And what's your view about which commodity is leading right now? It's time
Yeah,
to see
this
the bull.
Yeah, this is a really, really good question, because you could pick any commodity right now and make an argument for why or why not it would lead to the upside. What I'm going to be watching is what commodity leads to the downside. And this goes all the way back to the beginning of our conversation of less competition for corn out of South America, and the idea that the South American Brazilian bean production is above 130 million tons. If that's the case and we're right around the corner for harvesting, I would think that the Paranagua port price would start to really dip, or we would start to see the Chinese pick up a lot more Brazilian beans as we go forward after this month. And so when we start to hear export sales, we hear more Brazilian bean sales purchases from China as we get into the late February, 1st of March. So I still think the soybeans hold the key to whether we go lower or not. And that goes for both old crop and new crop. I still feel at $12 new crop beans, November beans, against a $4.45 corn price in the new crop, you're still holding on to a lot more bean acres, and you need more corn acres.
And do you think those recent rallies are solid?
This is where it goes back to a supply-led market. Supply-led markets don't last very long because you cut demand off so fast. It's kind of like the old story of the frog that you put in the water. If you put it in lukewarm water and turn the heat up slowly, it won't jump out. But if you put a frog into boiling water, it jumps out really quickly. a market going straight up like we've seen here since November in soybeans and since Christmas time in corn, I think it's boiling water. And I think that demand's going to get hit very, very sharply. And it's really going to hurt us down the road, especially if we don't have La Nina to rely upon after the springtime.
And what about the trends for the livestock sector?
I think the hogs have made another short-term low at this point. We're hearing a lot of disease presence and problems in the major hog producing areas here in this country, Luis. We saw the pork export sales also recover this past week. So I feel like $72 is kind of a brick wall of resistance for lead month hogs. But also by the same token, you get down into the mid to low 60s. That's probably a very strong support area as well. And we just tested that. So I would think that the hogs would try and make another run to the upside unless that pork and bean trade comes in and messes with us. In other words, if the soybeans want to continue lower after the Martin Luther King holiday and break through some technical support, then we might see funds take off both hogs and soybean positions. Cattle, I think feeders probably have just made a low as well at the 132 level, but I don't think the market's got a lot of upside until we get past the January time period and get into February. And that's mainly because live cattle. I think it's going to be hard for the fats to get above 112 at this stage.
And your final conclusion, sir?
Well, I think the USDA report gave something for everybody. I think at the end of the day, what I want to focus on is where is there a tight supply? Don't rely upon La Nina too much. And remember that Brazil is right around the corner from harvesting their soybeans. And that second crop, safrinha corn, is most likely going to be hitting the hottest time period in Brazil's weather seasonal because it's been delayed. So I continue on the idea of the soybeans having a bigger premium than the corn market right now, and that the wheat has a lot to do with that.
Thanks a lot, Mike.
Thank you, Luis.